Before we begin, it's important to understand that this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent, and the information presented here is not a substitute for professional advice tailored to your individual circumstances. Insurance products, regulations, and pricing are complex and vary significantly by state, provider, and your personal profile. Always consult with a qualified and licensed professional before making any financial decisions or purchasing an insurance policy. Your financial situation is unique, and the strategies discussed in this presentation may not be suitable for everyone. You are almost certainly overpaying for your car insurance. I don't mean by a little. I mean you are potentially lighting hundreds, maybe even over $1,000 on fire every single year. And the worst part? The companies you think are saving you money are often the ones picking your pocket the cleanest. You know the feeling. That renewal notice shows up in your email. You open it with a sense of dread, and there it is. Your rate went up. Again, you didn't get any tickets. You didn't have an accident. You drove less this year. But the price went up. So you grit your teeth, you pay it, and you tell yourself, well, that's just how it is. But it's not. It's a carefully designed system to profit from your inaction. For the next few minutes, we are going to dismantle that system. We are going to expose the single biggest lie in the auto insurance industry. A lie propagated by billions of dollars in advertising featuring talking lizards, goofy mascots, and catchy jingles. That lie is that going direct is always cheaper. The idea that by cutting out the middleman, you're getting a better deal from companies like Geico, Progressive, or Insurance. By the end of this video, you will not only understand why that is often completely false, but you will have a rock-solid step-by-step framework to find the absolute best rate for the best coverage, turning you from a price taker into a master negotiator. This isn't about theory. This is about giving you the exact playbook the insurance companies hope you never, ever find. Let me tell you a quick story about a guy we'll call David. David was the perfect customer. For 12 years, he was with the same big-name, direct-to-consumer insurance company. He signed up online when he was 25 because their ad was funny and the process was easy. Every 6 months, his rate would tick up by 10 or 20 bucks. He'd grumble, but he was busy. He figured switching was a hassle, and besides, he was a loyal customer. They even sent him a little gold star sticker for his file. He felt taken care of. Then his wife got a new car. When he went to add it to his policy, the quote they gave him was astronomical. It was so high it just felt wrong. For the first time in over a decade, that feeling of frustration finally boiled over into action. On a lunch break, he made a phone call. Not to another giant insurance company, but to a local, independent insurance agent his coworker had mentioned. He gave the agent the exact same information he had with his loyal provider. Same cars, same drivers, same coverage limits, same deductibles. An hour later, the agent called back. He had quotes from 7 different carriers. The best one wasn't just a little cheaper. It was $1,124 cheaper per year for the exact same coverage from a highly rated, A-plus insurance company. David was stunned. Then he got angry. 12 years of loyalty, 12 years of paying more than he had to, all because he believed the myth. He believed that going direct was the smart move. David's story isn't an exception. It's the norm. And it's happening because most people don't understand the fundamental battle being waged for their dollars. In the world of auto insurance, there are 2 armies fighting for your business: the direct writers and the independent agents. Understanding how these 2 armies operate is the first critical step to saving a fortune. First, you have the direct writers. Think of them as the titans: Geico, Progressive, Liberty Mutual, Insurance. These companies are marketing machines. They spend billions, literally billions with a B, on advertising every single year to drill one message into your head: come directly to us. They want you on their website or their app. Why? Because once you're in their ecosystem, they have total control. A direct writer can only sell you one thing: their own product. When you go to Geico for a quote, they can't tell you if State Farm or Nationwide might be cheaper. Of course not. They can only sell you Geico. They are a one-product store. Their entire business model is built on spending an enormous amount of money to convince millions of people that their single product is the best and cheapest option, even though for a huge percentage of the population, it mathematically cannot be. Think about it like this. Imagine wanting to buy a new television. You could go directly to the Sony store. The Sony salesman is going to be friendly, knowledgeable, and will tell you everything that's great about a Sony TV. But he is never, ever going to tell you that the new Samsung or LG model across the street is a better fit for your needs and is currently on sale for $300 less. His job is to sell you a Sony. Direct insurance companies are the Sony store. They are very, very good at selling their own product. Now let's look at the other army. The independent agents. An independent agent is not an employee of an insurance company. They are an independent business owner whose job is to represent you, the customer. They are the TV superstore. When you walk into that store and say, "I need a 65-inch TV for my living room," the salesperson doesn't just show you the Sony. They show you the Sony, the Samsung, the LG, the Vizio. They know the pros and cons of each. They know which one has a special rebate this week and which one has a better warranty. They work for you to find the best product among all the brands they carry. An independent insurance agent does the exact same thing. They partner with dozens of different insurance carriers, companies like Travelers, Safeco, The Hartford, and many other A-rated companies you've probably never even heard of because they don't spend $1 billion a year on advertising. When you call an independent agent, you give them your information one time. They then take that information and submit it to their entire network of carriers. They effectively force the insurance companies to compete for your business. One carrier might be great for a 22-year-old driver with a sports car. Another might specialize in families with minivans and perfect driving records. And a third might offer the best rates for someone who had a fender bender 2 years ago. The direct writer offers you a single data point. The independent agent offers you the entire market. So the question becomes, why doesn't everyone just use an independent agent? Why do the direct writers have a massive share of the market? The answer is a masterclass in psychology, marketing, and exploiting a key weakness in the independent agent model that you need to be aware of. The direct companies have built their empires on the idea of speed and convenience, making you believe that a 15-minute online quote is the same as getting the best price. It is not. They have weaponized the idea of cutting out the middleman, framing the agent as an unnecessary cost, when in reality, the agent's commission is already built into the insurance premium, whether you use one or not. You don't pay the agent directly, the insurance company does. So by going direct, you're not saving the commission, you're just doing all the work yourself and only getting one option. You become your own unpaid one-product agent. We're just getting started. Now that you understand the two players on the field, we need to talk about the secret rules of the game they're playing. The hidden factors that jack up your insurance rates that have absolutely nothing to do with your driving. Let's peel back the curtain. The first thing you have to understand is that auto insurance isn't really about your driving. I know that sounds insane, but it's true. Your driving record is a piece of the puzzle, yes, but it's often a smaller piece than you think. The game is about predicting risk, and insurance companies have become masters of data, using complex algorithms to build a profile of you that decides whether you're a good bet or a bad one. And the most powerful, most controversial piece of data they use has nothing to do with your car. It's your credit score. Yes, your credit. In most states, the 3-digit number that decides if you can get a mortgage is one of the single biggest factors in determining your car insurance premium. The industry doesn't call it a credit score, of course. That sounds a little too invasive. They call it a credit-based insurance score. It's a special score calculated just for them, but it's built from the exact same information on your credit report. Your payment history, your debt levels, how long you've had credit. Here's why they do it. Decades ago, insurance actuaries, the mathematicians who run this whole industry, discovered a bizarrely strong statistical correlation. People with lower credit scores on average file more insurance claims. Not just more, but more expensive claims. They're also statistically more likely to miss a payment or even commit insurance fraud. Now, does your FICO score of 620 mean you're going to fake an accident? Of course not. But to an algorithm sifting through millions of data points, you fit a profile. You look like a higher risk. Think about it this way. Meet two people, let's call them David and Maria. They live on the same street in a suburb of Dallas. Both are 40 years old, both drive a 2021 Honda CR-V, and both have a spotless driving record. Not a single ticket or at-fault accident in over a decade. On paper, they are identical drivers. But David pays $95 a month for his insurance. Maria pays $180, nearly double. The only significant difference? David has an 810 credit score. Maria, after a nasty divorce and some unexpected medical bills, has a score of 580. Maria isn't a worse driver than David. She's just as safe, just as responsible behind the wheel. But the insurance company's computer doesn't see a person who went through a tough time. Sees a number. It sees a data point that screams financial instability, and their historical data tells them that financial instability is a strong predictor of future claims. It's cold, it's impersonal, and in many ways it feels deeply unfair. You're being penalized not for what you've done, but for what people like you in a spreadsheet have done. This practice is so controversial that a few states have actually banned it. If you live in California, Hawaii, or Massachusetts, insurers are legally forbidden from using your credit score to set your rates. Michigan has also heavily restricted its use. But for the vast majority of Americans, your credit history is a silent passenger in your car, whispering to your insurance company how much they should charge you. But it doesn't stop there. The next secret factor is your address. Not just your city or state, but your specific 5-digit zip code. You could be the safest driver in the world, but if you live in the wrong zip code, you will pay more. Period. They call this territorial rating. It's a geography tax. Imagine you find a new apartment that you love. It's just 3 miles away from your old place across a town line. Your commute is the same. Your car is parked in a similar garage. Nothing about your life as a driver has changed. You update your address with your insurance company, and your 6-month premium suddenly jumps by $300. Welcome to the power of the zip code. What are they looking at? First, they look at the claims history of everyone else in that zip code. Is it an area with a lot of accidents? Is there a higher rate of car theft or vandalism? You're paying for the actions of your neighbors. Second, they look at population density. A quiet, rural zip code with 2-lane roads has a much lower statistical probability of accidents than a dense urban zip code with constant traffic, even if you personally only drive on weekends. But here's the most shocking part of the geography tax: the local legal climate. Insurance companies track how often people in your area get lawyers and file lawsuits after an accident. They track the average size of jury awards in your local courts. If you live in a litigious area, a place where people are more likely to sue for big payouts, your liability coverage costs will be sky high. The company has to price in the risk that a minor fender bender could turn into a multi-million-dollar legal battle. You are literally paying more because your neighbors as a group are more likely to take an insurance company to court. So your credit score and your zip code are already working for or against you before you even get in the driver's seat. But the algorithm is just getting warmed up. The third hidden factor is your demographic profile. And this is where it gets uncomfortably personal. They look at your occupation and your level of education. Statistically, insurance companies have found that people in certain jobs are lower risks. Engineers, for example, often get better rates. The industry's logic is that an engineer's brain is wired to be methodical, precise, and risk-averse. The same often applies to scientists, teachers, and pilots. On the other hand, jobs that involve high stress, irregular hours, or a lot of time on the road, think salespeople, journalists, or doctors, can sometimes result in higher premiums. They're not judging your individual character. They're judging the statistical caricature of your profession. Your education level works the same way. A PhD or a master's degree can often unlock a discount. Why? Because the data shows a correlation between higher education and lower claims frequency. The theory is that it's a proxy for income, stability, and a more predictable lifestyle. It feels like a form of digital profiling, a system that rewards people for fitting into neat, low-risk boxes. Let's step back and look at the battlefield. On one side, you have the direct insurers with their massive marketing budgets and sophisticated algorithms. On the other, you have the independent agents with their network of different carriers. And in the middle is you, a collection of data points. You are a credit score, a zip code, a job title, and an education level. Your driving record is just one more variable in a very complex equation. This is the secret game being played. It's a game of statistics, not a game of driving skill. The question is, which model is better equipped to navigate this system for you? Does the direct-to-consumer model, with its powerful centralized algorithm, find the absolute best fit for your specific data profile? Or is their algorithm designed to find the best fit for their bottom line? And what about the independent agent? Can a human being, armed with knowledge and access to multiple companies, really beat a supercomputer? Can they find a carrier whose specific appetite for risk happens to match your profile perfectly? Maybe one company is more forgiving of a low credit score if you live in a good zip code. Maybe another specializes in insuring people in your profession and offers a huge discount. The direct company will never tell you that a competitor is a better fit. An independent agent's entire job is to do exactly that. So we have these giant impersonal data points that are largely outside of your immediate control. A direct insurer's algorithm is going to look at this data in a very specific, rigid way. An independent agent has a different approach. But which one actually saves you money when the system seems rigged against you from the start? The answer comes down to one crucial difference in their business models. A difference that can either trap you or set you free. And that's exactly what we're breaking down next. This fundamental difference is all about who the salesperson works for. It's the battle between the captive agent and the independent agent. Think of it like this: you need a new pair of running shoes. You have two options. You can go to the official Nike store, or you can go to a big shoe store like Foot Locker. Going to the Nike store is like using a direct insurance company. Think State Farm, Allstate, or Farmers. The person helping you is a captive agent. They work directly for Nike. They know everything there is to know about Nike shoes. They can tell you the exact foam density in the latest Pegasus model, the history of the Air Max, and which shoe is best for marathon training versus a 5K. They are experts in their brand. But if you walk in and say, "I'm thinking about a pair of Adidas Ultra Boost," what happens? They can't help you. Their job, their entire purpose is to sell you a Nike shoe. Their loyalty is to the swoosh. They have one product line, one set of prices, and one set of rules. Their goal is to find the best Nike shoe for you, but if the best shoe for you isn't a Nike, you're out of luck. This is the world of direct insurance. A Geico agent works for Geico. A Progressive agent works for Progressive. They are experts on their company's policies. They know every discount, every endorsement, every loophole within their specific system. And for some people, this is great. It's simple, it's streamlined, and you're dealing with a massive recognizable brand. The problem arises when that brand is no longer the best fit for you. Let's say you have a clean driving record and get a fantastic rate with Direct Auto Corporation. You're happy. A year later, you get into a small fender bender. It wasn't even your fault, but it's on your record. At renewal, your premium skyrockets by 40%. You call your captive agent, the person who was so helpful last year. You ask them what you can do. They'll look for discounts. Maybe you can bundle your home insurance. Maybe you can take a defensive driving course for a 5% reduction. But at the end of the day, they can only offer you solutions from within the walls of Direct Auto Corporation. They cannot tell you, "You know what? Our company is really tough on accidents like this. You should check out our competitor, Premium Savers Incorporated. They're much more forgiving and will probably save you $800 a year." Saying that would be like the Nike employee telling you to go buy Adidas. They would be fired on the spot. Their hands are tied. Their loyalty is to their employer, not to your wallet. You are captive just like they are. Now let's go back to our shoe analogy. Instead of the Nike store, you walk into Foot Locker. This is the world of the independent agent. The salesperson at Foot Locker doesn't work for Nike. They don't work for Adidas or New Balance or Asics. They work for you, the customer. Their goal is to sell you the best possible shoe for your needs from all the brands they carry. You walk in and say, "I have flat feet, I overpronate, and I'm training for a half marathon." The salesperson can now pull a Nike, an Adidas, and a Brooks off the shelf. They can have you try all three. They can explain the stability features of the Brooks, the cushioning of the Adidas, and the lightweight design of the Nike. They have access to the entire market. Their loyalty is to you, the runner, because they want you to come back to Foot Locker next time, regardless of which brand you choose. This is what an independent insurance agent does. They don't work for one single company. They are contracted with dozens of different insurance carriers, companies like Travelers, Safeco, Nationwide, and many others you might not have even heard of. When you call an independent agent and say, "I just had a fender bender and my rates went up," their response is completely different. They say, "Okay, your current company is no longer competitive for your situation. Let me do the shopping for you." They then take your information and submit it to their entire network of 15, 20, or even 30 different carriers. Within hours, they can come back to you and say, "All right, I've got quotes from 12 different companies. It looks like Carrier A is the cheapest, but Carrier B offers much better coverage for just $10 more a month, and they have accident forgiveness, so this won't happen again. Which one would you prefer?" You see the difference? It's a seismic shift in the power dynamic. The agent is now your personal advocate, your market analyst, your negotiator. Their job isn't to sell you one specific product. Their job is to find you the best solution in the entire marketplace. So, let's circle back to the core question. Are direct auto insurance companies cheaper? The answer is a frustrating sometimes. A direct company like Progressive might have the absolute best algorithm, and the lowest price for a 25-year-old single woman with a perfect record driving a Toyota Camry in rural Ohio. For that one specific person, at that one specific moment in time, yes, they are the cheapest. The problem is, life isn't a static snapshot. What happens when that woman gets married, or moves to a city, or buys a new car, or adds a 16-year-old son to her policy? Suddenly, Progressive's magical algorithm might see her as a massive risk, and her rates could double or triple overnight. If she's with a captive Progressive agent, her only option is to pay the massive increase or spend her entire weekend online, filling out dozens of different quote forms, trying to find a better deal herself. If she were with an independent agent, her agent would get the renewal notice, see the massive price hike, and proactively reshop her policy across the market before she even has to ask. The agent does the work, finds the new best carrier for her changed circumstances, and saves her the time, the headache, and the money. Direct companies thrive on what I call the illusion of choice. They spend billions on ads with catchy jingles and funny mascots to get you to their website. Once you're there, they give you all these options. Do you want the basic plan, the plus plan, or the premium plan? Do you want a $500 deductible or a $1,000 deductible? Feels like you're in control. It feels like you're making smart choices, but you're only choosing between options in a single walled-off garden. You are only ever comparing Coke to Diet Coke. You never even get to see the price of a Pepsi. The most important choice, the choice of which company to use, was already made for you the moment you landed on their website. This business model is the fundamental reason why the answer to who is cheaper is so complex. It's not about one company always being cheaper than another. It's about which system gives you the power to find the cheapest option for you. Not just today, but every single year as your life changes. So, if the independent model offers so much more choice and long-term value, why do direct companies dominate the airwaves in our minds? Why do we instinctively go to their websites first? It's because they have mastered a powerful psychological game. A strategy built on massive advertising budgets and sophisticated pricing algorithms designed to make you feel like you're winning, even when the house has a hidden edge. And we're about to expose exactly how those algorithms are programmed to think, and more importantly, how they're programmed to think about you. So let's pull back the curtain on this digital wizard. At its core, an insurance pricing algorithm is a giant hyper-complex recipe. The insurance company wants to bake a price cake, and you are the ingredients. Some of these ingredients are obvious, the flour and sugar of the recipe. We're talking about the things you'd expect: your age, your gender, and of course your driving record. A 21-year-old male with 2 speeding tickets is, statistically speaking, a much riskier ingredient than a 45-year-old woman with a spotless record. No surprise there. The algorithm crunches decades of data from millions of drivers and concludes, with cold, hard certainty, that one profile costs them more in claims than the other. Then there's the car you drive. The algorithm doesn't just see a 2022 Honda Civic. It sees a vehicle with a specific theft rate, known repair costs, a 5-star safety rating, and an engine size that suggests you're not drag racing on weekends. It compares that to a 2022 Corvette, which has a much higher theft rate, astronomical repair costs for its carbon fiber body panels, and an engine that screams expensive claim waiting to happen. The algorithm cross-references this with your zip code. Are you parking that Corvette in a sleepy suburban cul-de-sac with low crime rates? Or are you parking it on the street in a dense urban center notorious for sideswipes and break-ins? It knows the accident frequency at the intersection a block from your house. It knows the average hourly labor rate at the body shops in your town. This is the first layer of the cake, the base. It's all logical, if a bit unsettling in its precision. But this is where direct insurance companies start to get a serious advantage, and where the recipe gets weird. They don't have to pay an agent, so they can invest millions more into data acquisition and refining these algorithms. They start adding ingredients that have little or nothing to do with how you drive. The most important and controversial one? Your credit score. Now wait a minute. What does your ability to manage a credit card have to do with your ability to merge onto a highway? The insurance industry's official line is that there's a strong statistical correlation. They claim that people who are responsible with their finances are also more likely to be responsible in other areas of their life, like, say, maintaining their car's brakes or not running red lights. People with lower credit scores, their data suggests, file more claims. Not just more accident claims, but more comprehensive claims, like reporting a cracked windshield or a stolen catalytic converter. To the algorithm, a low credit score is a big, flashing red light that says higher risk. But let's be real. Does that feel right to you? Imagine two identical drivers. Let's call them Sarah and Jessica. Same age, same car, same clean driving record. Live in the same apartment building. But Sarah is a recent college grad with a thin credit file and some student loan debt. Jessica, on the other hand, has had a credit card for 10 years and a stable, well-paying job. The algorithm will almost certainly quote Sarah a significantly higher premium, maybe hundreds of dollars more per year. Not because she's a worse driver. By all available metrics she's an identical driver, but because of a number generated by a credit bureau. What if your credit took a hit because of a medical emergency? Or a messy divorce? Or a layoff during a pandemic? The algorithm doesn't care about the story. It doesn't see a human being dealing with life. It sees a 3-digit number and flags you as a liability. This single factor is one of the biggest reasons two seemingly identical people can get wildly different quotes from the same direct insurer. It's a proxy for wealth, plain and simple. And it gets even deeper. The algorithm isn't just looking at who you are. It's watching what you do. This is the secret weapon of the direct-to-consumer model. When you go to an independent agent, your interaction is with a human. When you go to a direct insurer's website, every single click, every hesitation, every field you fill out and then change, is being logged and analyzed. This is where we enter the world of price optimization, which is a pleasant-sounding corporate term for figuring out the absolute maximum amount of money they can charge you before you give up and go elsewhere. Think about it. You start filling out their online form. The algorithm is already building a profile. Did you come from a Google search for cheap car insurance? Or did you type their URL in directly, suggesting you're already a loyal customer or got a recommendation? A customer who types the name directly is often considered less price-sensitive. Touching your potential price just ticked up a few dollars. Did you get a quote, then close the browser window only to come back 2 days later? The algorithm sees this. It interprets it as, they shopped around and didn't find anything better. They're back. We have some leverage here. It might hold the price steady, or even bump it up slightly, knowing you're likely to accept. Conversely, did you get a quote and then immediately start tweaking the numbers? Lowering your coverage from $100/$300 to the state minimum? Changing your deductible from $500 to $1,000? This behavior screams, I am extremely sensitive to price. The algorithm flags you as a bargain hunter. For you, it might trim the profit margin down to the bare minimum, offering you that super attractive lowball rate you see in the commercials just to get you in the door. It's a calculated gamble. They might not make much money off you in the first 6 months, but they're betting that once you're a customer, you'll fall into what they call inertia. You'll set up autopay, you'll get comfortable, and you won't bother to shop around again when your renewal comes up. And that's when they'll start raising your rates bit by bit, testing your pain tolerance. This is the real game. The price you are quoted by a direct insurer is not a simple calculation of your risk. It is an incredibly complex, personalized assessment of your perceived willingness to pay. They are building a psychological profile of you as a consumer. Are you a loyal customer they can squeeze for higher profits? Are you a shopper they need to entice with a rock-bottom price? Are you desperate? Maybe your old policy just lapsed and you need insurance today? The algorithm can infer all of this, and it adjusts the price accordingly. So when you see that ad with the friendly mascot promising to save you hundreds, what they're not telling you is that this promise is conditional. It's conditional on their algorithm identifying you as the right kind of customer to give a discount to. The person right next door with the same car and same driving record might be secretly subsidizing your great rate simply because their online behavior, or their credit history, tag them as someone who would tolerate paying more. The house isn't just setting the odds. It's constantly changing them based on how it thinks each individual player will behave. And this digital profiling has created a massive gap, a hidden trapdoor in the floor of the insurance marketplace. Some people fall through it into a pit of higher premiums, while others are guided to a treasure chest of discounts. The question is, which one are you? And more importantly, can you change what the algorithm thinks of you? The answer is a resounding yes. But it's not about tricking the system or finding some secret back door. It's about understanding the system's language. And the most important word in that language is your insurance score. Now, you've heard of your credit score, right? That 3-digit number that dictates whether you can get a loan, a mortgage, or a credit card. Well, the insurance industry has its own version, often called a credit-based insurance score. It is one of the most powerful and most misunderstood factors in determining your premium. And here's the kicker. It has almost nothing to do with how you drive. This isn't your FICO score, but it's built from the same raw material. your credit report. Insurers, armed with decades of data and armies of statisticians, discovered a chillingly accurate correlation. They found that how a person manages their financial life is a remarkably strong predictor of how likely they are to file an insurance claim. Think about that for a second. The number of late payments you've had, your total amount of debt, the length of your credit history, and whether you've recently applied for new credit can have a bigger impact on your car insurance rate than a minor fender bender. To the insurance company's algorithm, a maxed-out credit card is a bigger red flag than a speeding ticket. Why? The industry will tell you it's about responsibility. The theory goes that a person who is meticulous about paying their bills on time and managing their debt is also more likely to be responsible in other areas of their life. They're more likely to get their oil changed on time, replace their bald tires, and generally be a more conscientious, lower-risk driver. There's another, more cynical theory. It suggests that a person under significant financial stress might be more likely to file a claim for every little scratch and dent, things a more financially stable person might just pay for out of pocket to avoid the hassle. Or worse, that financial desperation could lead to inflating a claim or even committing outright fraud. The algorithm doesn't care which theory is true. It doesn't judge you. It's not personal. It only cares about one thing: correlation. And the correlation between a low credit-based insurance score and a high likelihood of filing claims is, according to their data, undeniable. So, the system prices you accordingly. This is where the chasm between the direct-to-consumer model and the independent agent model truly opens up. Direct insurers are the masters of this data-driven world. Their entire business model is built on algorithmic efficiency. When you go to their website and enter your information, their system doesn't just see a name and address. In milliseconds, it pulls a web of data about you, with your insurance score sitting right at the center. Let's imagine two different people. We'll call them Alex and Brenda. Both are 35 years old, live in the same town, drive the same kind of car, and have spotless driving records. Not a single accident or ticket between them. On the surface, they should pay the same for insurance. But they won't. Alex is the algorithm's dream customer. He's a homeowner. He's had the same job for 10 years. He has a 20-year credit history with 0 late payments and keeps his credit card balances low. His credit-based insurance score is pristine. Alex goes to the website of a huge direct insurer. The algorithm takes one look at his data profile and essentially rolls out the red carpet. It sees him as a preferred risk, stable, responsible, and statistically very unlikely to cost them money. It instantly offers him their absolute best, rock-bottom rate. For Alex, the process is magical. It takes 5 minutes, he saves $400 a year. And he thinks, wow, direct insurance is amazing. It's so much cheaper. Now let's look at Brenda. Remember, she has the exact same perfect driving record. But her story is different. Brenda is a renter, not a homeowner. She's a freelance graphic designer, so her income isn't as predictable. And she's changed jobs on paper a few times in the last 5 years as she's built her business. A few years ago, she had a major medical issue that led to a pile of bills. While she paid them off, a few went to collections and damaged her credit history. Brenda goes to the very same direct insurer's website, minutes after Alex. She enters the exact same car and address. But the algorithm sees a completely different person. It sees renter, which it flags as a slightly higher risk than homeowner. It sees a variable employment history, another small red flag. And then it pulls her credit-based insurance score. It sees the past collections, the higher debt-to-income ratio. It doesn't see the context, the medical emergency, the entrepreneurial spirit. It just sees data points that correlate with a higher risk of filing a claim. The algorithm doesn't offer Brenda the red carpet rate. It doesn't even offer her the standard rate. It shunts her into a substandard, high-risk category. The premium it quotes her is double what Alex was offered. Double. For the same coverage on the same car with the same perfect driving record. Brenda is left confused and angry. She knows she's a safe driver. Why is her quote so high? She has no one to talk to, no one to explain her situation to. There's just a buy now button with a number that feels like a punishment. For Brenda, the direct model is a black box that just spit out a bad answer. This is the fundamental trade-off. The direct model offers incredible speed and potentially incredible savings, but only if you fit their perfect algorithmically defined mold. It's a system designed to reward the Alex of the world. If you are not an Alex, you risk falling through the cracks. This is where an independent agent can change the game. An agent also knows that insurance scores are critical, but they have a crucial advantage: options. An agent isn't beholden to a single algorithm. They have access to 10, 20, or even more different insurance companies, each with its own unique algorithm and its own definition of the perfect customer. An agent could look at Brenda's profile and immediately know which doors to knock on. They'd say, okay, this big national direct style carrier is out. Their algorithm is brutal on credit. But I know a regional carrier that puts a much heavier emphasis on driving record than credit. And there's another company that gives a special discount for self-employed professionals that could help offset the score. Let's get quotes from them. The agent acts as a human translator, taking Brenda's nuanced life story and finding the specific insurance company whose algorithm will understand it best. They can't change her history, but they can shop her history to a much wider market, finding the one company that sees her as a responsible driver who had a tough break, not just a high-risk number. So when we ask, can you change what the algorithm thinks of you? The answer is yes in two ways. The long-term way is to actively manage the factors that make up your insurance score. Pay your bills on time every time. Keep your credit utilization low. Don't let small medical bills snowball into collections. Over a year or two, these actions will genuinely improve your score and make you look better to every insurance algorithm, lowering your rates across the board. But the short-term, immediate way to change what the algorithm thinks is to change the algorithm you're talking to. The secret isn't just about improving your profile. It's about finding the company whose system is built to favor your specific profile, warts and all. If you're an Alex, the direct route might be a slam dunk. If you're a Brenda, an independent agent might be your only hope of not being unfairly penalized. The algorithm, in the end, is just a hyper-efficient sorting hat. It's designed to quickly place you into a risk category. The real secret to saving money is understanding which sorting process will see you most favorably. But your insurance score is just the beginning of the story. There are other forces at play, other algorithmic tricks that are far more controversial. One of them is a practice known as price optimization. It has nothing to do with your risk, your driving record, or your credit. It has everything to do with how likely the insurance company thinks you are to shop around. It's a system designed to charge loyal customers more money, simply because they can get away with it. And it might be costing you a fortune. So how do they get away with it? It's called price optimization. And it's one of the dirtiest little secrets in the entire insurance industry. Think of it like your cable bill or your cell phone bill. You sign up for a great introductory rate and you're happy. A year goes by, the price creeps up a little. You don't really notice. Another year, another small bump. Before you know it, you're paying 30% more than a new customer for the exact same service. You call to complain, and suddenly, magically, they find a special promotion to bring your rate back down. They weren't rewarding your loyalty. They were banking on your inattention. Insurance companies have turned this into a science. They use hundreds, even thousands of data points to build a profile on you. They know how long you've been a customer. They know if you pay your bill in full or in monthly installments. They know if you're on autopay. They might even purchase data that shows what websites you visit, what you buy online, and how often you search for things like cheap car insurance. They feed all of this into an algorithm, and it spits out a single critical score, your price elasticity, a fancy term for how likely you are to leave if they raise your rates. Let's imagine two people, both with perfect driving records, same car, same neighborhood. Let's call them Sarah and Mike. Sarah has been with, let's call them, Direct Shore for 10 years. She set up autopay on day one and hasn't thought about it since. She's never had a claim, never been late on a payment. She is, by all accounts, the perfect customer. Mike, on the other hand, just signed up with Direct Shore 6 months ago. He came from a competitor because they offered him a rate that was $10 a month cheaper. When renewal time comes, the algorithm looks at Sarah. It sees 10 years of uninterrupted payments. It sees she hasn't logged into her account in 3 years. It sees no recent insurance quotes run under her name anywhere online. The algorithm flags Sarah as inelastic. She's sticky. She's not going anywhere. So Direct Shore's computers decide to test her loyalty. They add a 12% optimized increase to her premium. It has nothing to do with her risk. It's not because of inflation or repair costs. It is a tax on her loyalty. It's pure, calculated profit, extracted from a customer they believe won't fight back. Now the algorithm looks at Mike. It sees he just switched for a tiny $10 savings. It sees his web history is full of visits to insurance comparison sites. The algorithm flags Mike as highly elastic. He's a shopper. He'll bolt for the price of a cup of coffee. So what does Direct Shore do? They give Mike the best possible rate. They might even keep his premium flat or give him a tiny decrease. Even if Mike had a minor speeding ticket and Sarah didn't, Mike could still end up paying less. Because Mike's profile screams, "I will leave," and Sarah's profile whispers, "I will stay." This is the fundamental game being played, and when you deal directly with a single insurance company, you are playing it alone. You are Sarah, one person against a supercomputer armed with a dossier of your personal habits. You have no leverage. You have no insight into their pricing. Your only move is to spend hours of your own time becoming Mike. Manually shopping around every 6 months, filling out endless forms, and comparing apples to oranges just to keep them honest. This is where the entire structure of the independent agent model proves its worth. An independent agent is, in essence, a professional Mike who works for you. Their entire business is built on preventing you from becoming a Sarah. By their very nature, they break the price optimization model. When an agent gets your renewal and sees a 12% loyalty tax, they don't just pass it on to you. Their system immediately requotes your policy with the 10 or 15 other companies they represent. They create a competitive bidding situation. They call you and say, "Hey, DirectSure tried to hit you with a big increase, but I was able to move you over to a different, equally great company and actually save you $150 for the year." They have neutralized the loyalty tax. They have taken the power away from the single company's algorithm and put it back in your hands. The agent's job is to ensure you are always treated like a new customer, with the most competitive rate, without you having to lift a finger. That ongoing, automatic shopping is a form of value that a direct company simply cannot and will not ever offer. But the direct companies are smart. They know they have this weakness. So what do? They spend billions of dollars a year on advertising to convince you of a different story. They try to shift the definition of value away from price and advocacy and towards technology and convenience. They sell you on the Slick app, the ability to file a claim with a few taps, the 24/7 chatbot. They create the illusion that this digital convenience is a superior form of service. Let's be brutally honest about what that service really is. When you have a problem and you call that 800 number, you are talking to a call center employee. That employee's job is not to be your best friend. Their job is to follow a script and resolve your call as quickly as possible. They are measured on average handle time. They are a representative of the company, and their primary loyalty is to the company's bottom line, not to you. The chatbot isn't your advocate. It's a program designed to deflect you from speaking to a real and more expensive human being. The Slick app is a user interface, not a relationship. It's a tool for the company to manage you, the claimant, more efficiently and cheaply. Now contrast that with the independent agent model. The worst day of your life happens. You're in a serious accident. Your car is mangled. You might be hurt. You're definitely shaken up and confused. Who do you call? With the direct model, you call a faceless 800 number and become claim number 7-5 Charlie Bravo 9. You will tell your story to the first person who answers. Then you'll tell it again to the adjuster they assign. Then you might tell it again to the total loss specialist, and again to the subrogation department. You are alone, navigating a complex adversarial system designed to pay out as little as legally possible. With an agent, you make one call to a person whose name you know, a person who might even live in your town. You say, "John, I've been in a terrible accident." And John says, "I am so sorry to hear that. Are you okay? Don't worry about the insurance stuff right now, I'll handle it." And he does. He reports the claim for you. He knows your policy inside and out, so he can explain what's covered in plain English. When the company's adjuster calls you with a lowball offer on your totaled car, your agent is the one who steps in and says, "No, that's not a fair market value, and here's the data to prove it." The agent works for you. Their loyalty is to you. Their future business and reputation depend on making sure you are taken care of. That is the definition of real service. It's not an app. It's advocacy. It's a promise that when things go wrong, you will not be alone. So the idea that direct writers are cheaper is a dangerously incomplete picture. They might be cheaper on day one. They might be cheaper if you're willing to play the game and become a perpetual shopper. But over the long term, the loyalty tax can erode any initial savings. And the price you pay isn't just measured in dollars. It's measured in the stress, the confusion, and the potential financial devastation of navigating a serious claim all by yourself. But we're still just scratching the surface, because the price optimization and the service gap are only two parts of the equation. The biggest, most terrifying difference lies in the product itself, in the fine print of the policy documents that almost nobody ever reads. You might assume that a car insurance policy is a standard commodity product, that full coverage from one company is the same as full coverage from another. That is a catastrophic mistake. The subtle differences in policy language between a top-tier carrier and agent represents and a mass-market direct writer can be the difference between a paid claim and financial ruin. And that's exactly what we're going to expose next. Let's talk about a guy named David. David is a software engineer, a smart guy, meticulous in his work, and financially responsible. He has a wife, 2 kids, and a mortgage. Every year, like clockwork, he shops his auto insurance. He sees the commercials, the ones with the catchy jingles and the funny mascots, promising to save him hundreds. And one year he does it. He goes online, spends 15 minutes plugging in his information, and gets a quote from a massive direct-to-consumer insurance company. It's $250 cheaper for a 6-month policy. He feels a rush of satisfaction. He's beaten the system. He clicks buy, prints his new ID cards, and tells his wife how he just saved them $500 a year. He bought what he thought was the exact same coverage he had with his old agent-based company. 100/300/100 liability, and matching limits for uninsured and underinsured motorist coverage. He felt protected. He felt smart. 6 weeks later, David is driving home from a late night at the office. He's stopped at a red light on a quiet suburban street. The light turns green. He proceeds into the intersection, and in a flash of shattered glass and screeching metal, a drunk driver in a beat-up pickup truck blows through their red light and T-bones David's brand-new SUV, sending it spinning into a utility pole. David wakes up in the hospital with a concussion, 3 broken ribs, and a shattered femur. His SUV, the one he was so proud of, is a twisted wreck, a total loss. The police report is crystal clear. The other driver was 100% at fault, with a blood alcohol level 3 times the legal limit. As David begins a painful recovery, the financial reality sets in. His medical bills are soaring past $80,000. He'll be out of work for at least 4 months, meaning tens of thousands in lost income. The at-fault driver? He has the state minimum liability coverage, just $25,000. It's a drop in the bucket, but David isn't panicked. He remembers his policy. He has underinsured motorist coverage. He's a responsible guy. He paid for $100,000 of it. He thinks, okay, the other guy's insurance will pay their $25,000, and my insurance will cover the rest. I'm covered. And this is where his $500 savings becomes a $100,000 nightmare. His direct insurance company's adjuster calls him. They are polite but firm. They explain a tiny single sentence buried on page 37 of his 80-page policy document. It's called a set-off provision, and it works like this. The insurance company gets to subtract whatever the at-fault party pays from the coverage David bought. So, they take his $100,000 limit, and they subtract the $25,000 he's getting from the drunk driver's policy. Suddenly, the maximum David can get from his own insurance company, the one he faithfully paid, is now only $75,000. His total recovery is capped at his policy limit. He gets $25,000 from one, $75,000 from the other, for a total of $100,000. But his total damages, medical bills, lost wages, pain and suffering, are closer to $150,000. He is $50,000 in the hole. $50,000 in debt, because of a single sentence he never knew existed. His savings of $500 just cost him $50,000. Now let's rewind. What if David had stayed with his independent agent? His agent would have placed him with a top-tier carrier whose policy language was fundamentally different. Most high-quality policies sold through agents don't use that predatory set-off provision. Instead, they provide coverage that pays in addition to what the at-fault driver's policy pays. In that world, David would get the $25,000 from the drunk driver, and then he could claim up to his full $100,000 limit from his own policy. He would have had access to $125,000 in total coverage, more than enough to cover his initial bills and lost wages. He would have been made whole. The product was not the same. It just had the same name on the declaration page. This isn't a rare one-in-a-million loophole. This is a fundamental, calculated business decision. Direct writers compete almost exclusively on price. To get that price down, they have to reduce their risk. So they hollow out the policy from the inside. They write contracts that are full of these little gotchas. These set-offs, exclusions, and restrictive definitions that the average person will never spot. They are betting you won't read the contract. And they are right. Let's look at another one. It's called OEM parts, original equipment manufacturer. This is a huge one. Imagine you have a 3-year-old Honda Pilot, loaded with all the latest safety tech, lane keep assist, adaptive cruise control, emergency braking. You get into a minor front-end collision. Your bumper is cracked, and a headlight is smashed. You take it to the body shop. With a typical cheap direct writer policy, your contract will state that the insurer only has to pay for aftermarket or like-kind and quality parts. This means the shop will use a bumper made by a third-party company in Taiwan and a headlight assembly from a company you've never heard of. The problem? That new bumper might not fit perfectly. The gaps might be a little off. The paint might not match exactly. But the real danger is in the technology. Your car's advanced safety systems rely on sensors, cameras, and radar units that are precisely mounted and calibrated to work with original factory-spec parts. When you introduce an aftermarket part that wasn't made by Honda, those systems can fail. The lane keep assist might not track correctly. The emergency braking sensor, now sitting behind a slightly different piece of plastic, might not detect an obstacle in time. Your car is now less safe than it was before the repair. And on top of that, its resale value has just taken a nosedive. A trained eye or a Carfax report that shows a repair with non-OEM parts will tell a future buyer that this car is no longer factory original, costing you thousands when you go to sell it. A good independent agent, on the other hand, would have likely offered you an OEM endorsement for a few extra dollars a month. They would have explained, for the price of a couple of coffees, we can guarantee that if you're in an accident, your car will be repaired with brand new factory original parts from Honda. It will protect your safety systems and your car's value. You're given a choice. You're given counsel. The 15-minute online form gives you neither. It just defaults to the cheapest option, which puts all the risk squarely back on you. You see, the price you're quoted online from a direct writer is an illusion. It's not the true cost. The true cost is the premium you pay plus the financial risk they have subtly transferred back to you through a weaker contract. You're not buying the same product. You're buying a product that has been engineered piece by piece to cost the insurance company less at the moment of truth, the claim. And that moment is the only reason you buy insurance in the first place. So the policy itself can be a minefield, a financial trap waiting to be sprung by one bad day. But what happens when you actually have to use it? What's the claims experience really like when you're just policy number 8-million-7 should be in a massive call center versus having a dedicated professional agent in your corner fighting for you? The difference is staggering, and it's where the true cost of cheap insurance is finally, and often painfully, revealed. Let's play this out. Imagine two scenarios, same accident. A classic, no doubt about it, not your fault situation. You're sitting at a red light, minding your own business, and bam, someone plows into the back of you. Your neck is sore, your trunk is now in your back seat, and your day is completely ruined. But hey, that's what insurance is for, right? In scenario 1, you have that super cheap policy you bought directly online. You felt so smart saving that $35 a month. You pull out your phone, find the 1-800 number on your digital ID card, and you make the call. First, you navigate an automated phone tree that seems designed by a madman. Press 1 for a new claim. Press 2 for a new quote. To speak to a representative, press 7, then 4, then the star key, then say guacamole. Finally, you get into the queue. A robotic voice informs you that your estimated wait time is 48 minutes. 48 minutes later, a person picks up. You can hear the cacophony of a massive call center in the background. You explain what happened. They ask for your policy number, your name, the date, the time, the location, the other driver's information. You give it all to them. They are polite but detached. They give you a claim number, a long string of digits you frantically scribble on a napkin. They tell you an adjuster will be assigned and will contact you within 24 to 48 business hours. You ask about a rental car. They say the adjuster has to approve that after they determine liability. You ask about getting your car towed to your trusted body shop. They say you can, but they can't guarantee they'll cover the full cost unless it's one of their network-approved shops, the closest of which is 40 miles away. You hang up feeling uncertain. 2 business days go by. Silence. You call the 1-800 number again. Phone tree. Wait time, 35 minutes. You get a new person. You give them your new claim number. They say, oh, it looks like your claim is with Adjuster Johnson. He's handling a high volume of claims right now. I will send him an urgent email to contact you. That's it. That's all they can do. You are powerless. Another day passes. Adjuster Johnson finally calls. He sounds exhausted. You have to retell the entire story of the accident. He tells you he needs to get a recorded statement from the other driver before they can accept liability. But the other driver isn't answering his calls. So now you're in limbo. Your car is undrivable. You're paying for Ubers to get to work. The direct insurance company, the one you pay every single month, won't move forward until a person who is not their customer, the one who hit you, decides to cooperate. Days turn into a week. You've called the adjuster 5 times. 4 times it went to voicemail. The one time he answered, he just said, "Still waiting on the other party." Finally, they get a hold of the other driver and accept liability. Hooray! Now the appraisal. They tell you to download an app and take pictures of the damage. You're not a body shop expert, but you do your best. A day later, you get an email with a check attached. It's for $4,700. The problem? You took your car to your local trusted mechanic, the one who has worked on your family's cars for 20 years, and his estimate is for $8,200. You call your adjuster. He says, "Well, sir, our estimate is based on aftermarket parts and our standard labor rate. The check is what we're willing to pay. If your shop charges more, that's between you and them. Or you can take it to our approved shop 40 miles away." You are now faced with a choice. Fight a massive bureaucratic company by yourself, accept a shoddy repair from a shop you've never heard of, or pay thousands of dollars out of your own pocket for an accident that wasn't even your fault. That $35 a month you saved? It just cost you $3,500, not to mention a week of stress, anxiety, and missed work. Now let's rewind. Same accident, same car, but this time you have a policy through a local independent agent. Let's call her Susan. Bam! You get hit. You check that you're okay. Your first call isn't to a 1-800 number. It's to Susan's direct line. She answers. "Hey Mark, what's going on?" She knows your voice. You tell her what happened. Her immediate response isn't to ask for a policy number. It's, "Are you okay? Is everyone safe?" She immediately shifts into professional mode. "Okay, don't worry. I'm going to handle everything. Stay right there. I'm filing the claim electronically right now while we're on the phone. I'm getting a tow dispatched to your location to take the car to your guy, Bill's Auto Body. Don't even worry about the cost, they direct bill us. I'm also setting up your rental car. It'll be waiting for you at the Enterprise down the street in an hour. Just give them this confirmation number." She's not just a message taker. She is your advocate. She is your logistical coordinator in a moment of crisis. The next day, you get a call from the insurance company's adjuster. It's a warm introduction. Why? Because that adjuster knows Susan. They have a professional relationship. They know that if they don't treat Susan's client well, they'll have to answer to Susan, who sends them hundreds of thousands of dollars in business every year. You are not just claim number 8-10007-2B. You are Susan's client. It's a completely different dynamic. When the other driver is being difficult, you don't even hear about it. Susan does. She calls the adjuster and says, "Look, the police report is clear. My client has photos, let's not waste time. Waive his deductible, get this moving, and go after the other company yourselves. That's what we pay you for." And they do it. Because Susan knows the process, the pressure points, and the people. And when that estimate comes in, Susan is the one who gets it. If it's low, she's on the phone with the adjuster before you even know there's a problem. She's the one who sends over the estimate from Bill's Auto Body and says, "You know Bill does good work. This car needs an OEM bumper to maintain its safety rating. And your estimate for aftermarket parts isn't going to cut it. Let's get this approved so we can get Mark back on the road." She is the expert in your corner, fighting for you. You just have to focus on getting better. The difference isn't the insurance company necessarily, it's the system. In the direct model, you are the general contractor of your own disaster. You are the one responsible for project management, follow-up, negotiation, and quality control. You have to become an expert in claims processing overnight, all while dealing with the stress of the accident itself. With an agent, you have a professional contractor. Someone whose entire job, whose license and livelihood, depends on their ability to manage that disaster for you. The premium you pay doesn't just buy a policy. It buys you that person's expertise, their relationships, and their advocacy when you need it most. The extra money you pay isn't for a middleman, it's for a champion. So when we ask, are direct companies cheaper? The answer has to be, cheaper by what measure? Cheaper by the monthly premium? Yes, often. But what about the cost and time? The cost and stress? The cost of an improper repair that diminishes your car's value and safety? The cost of paying thousands out of pocket to bridge the gap between their lowball offer and a quality repair? When you factor in the true cost, the cost that only appears after a crisis, the entire equation flips. That cheap direct policy can suddenly become the most expensive decision you've ever made. But it goes even deeper than just the claims experience. The problems often start long before you ever get into an accident. They start with the piece of paper or the PDF that you think is your protection, the policy itself. Because what most people never realize is that a policy from a direct-to-consumer carrier and a policy from a traditional agent-based carrier are often not the same product at all. They may look the same on the surface, but hidden in the fine print, in the definitions and exclusions, are subtle but catastrophic differences that can leave you completely exposed. And that's what we need to look at next. Let's start with the most common and easiest to understand difference: how your car gets fixed. Imagine you just bought your dream car, a brand new, technologically advanced vehicle, maybe a new Rivian, a Tesla, or even a top-trim Ford F-150 loaded with sensors for lane assist, adaptive cruise control, and automatic braking. A few months later, someone runs a stop sign and T-bones your passenger side door. It's a nasty hit. You're okay, thankfully, but the car is a mess. You file a claim with your direct, online-only insurance company, the one that saved you $45 a month. The adjuster is polite enough and they approve the repair. But then you get the estimate from the body shop. The insurance company has specified the use of aftermarket and salvaged parts. Instead of a brand new factory door from Rivian, they've sourced a used one from a junkyard in another state. Instead of the original equipment manufacturer, or OEM Fender, they're using a cheap imitation piece made by a third-party company. You protest. You say, "This is a brand new $60,000 truck. I want original factory parts that were designed and crash tested for my vehicle." And the adjuster on the phone calmly refers you to page 17, section 4, subparagraph C of your policy. It's a clause called right to repair or limitation of cost, and it explicitly gives them the right to use parts of like kind and quality, which is their legal jargon for whatever is cheapest. That aftermarket fender might not line up perfectly, creating an unsightly gap. The salvage door might have hidden damage. And most critically, those imitation parts may not interact correctly with the dozens of sensors embedded in your vehicle's body. Your lane keep assist might become unreliable. Your blind spot monitor could fail. The car's safety systems, a primary reason you bought it, are now compromised. And your vehicle's resale value? It just plummeted. You saved $45 a month, but you've just lost thousands on the value of your primary asset and worse, compromised its safety. Now let's rewind. Imagine you had a policy through a good independent agent. They would have likely placed you with a carrier whose standard policy includes OEM parts coverage, at least for cars under a certain age. Or, if it was an optional add-on, a good agent would have explained the risk and likely recommended the extra $7 a month for an OEM endorsement. In that scenario, there is no argument. The body shop orders brand new, factory-sealed parts directly from the manufacturer. Your vehicle is restored to its pre-accident condition, with its safety systems and its value intact. The same accident, the same car, but two wildly different outcomes. One leaves you with a compromised, devalued vehicle, and the other makes you whole again. That difference wasn't the price. It was the quality of the contract. But it gets much, much worse than just parts. Let's talk about people. Let's say you're moving and your good friend Tom offers to help. You toss him the keys to your SUV, so he can take a load of boxes to the new place. On the way, he looks down for a second to check the GPS, and he rear-ends a minivan. It's a serious accident. The people in the minivan are injured, and their vehicle is totaled. The total liability for the medical bills and property damage comes to $250,000. It's a nightmare, but you think, this is why I have insurance. You call your direct, cut-rate provider, and they ask you a simple question. Was Tom a listed driver on your policy? You say no, he was just a friend borrowing the car for an hour. And that's when they drop the bomb. They inform you that your policy contains a named driver exclusion, or a highly restrictive permissive use clause. Because Tom wasn't your spouse or a family member living in your household who was explicitly listed on the policy declarations page, he's not covered. And because you are the owner of the vehicle, you are ultimately responsible. The insurance company denies the claim entirely. They send you a formal letter, wishing you the best of luck. Suddenly, you are personally on the hook for $250,000. Your savings, your home equity, your future wages. All of it is now at risk because of a single sentence hidden in the fine print of a policy you bought in 15 minutes online to save a few bucks. This isn't a scare tactic. These policies are out there, and they are becoming more common as direct insurers compete almost exclusively on price. They have to cut the coverage somewhere to get the price that low. Now, let's look at the same scenario with a standard policy from a top-tier carrier that an agent would recommend. In 99% of those policies, permissive use is broad. As long as you gave Tom permission to drive your car, he is covered by your liability insurance, just as if you were behind the wheel yourself. The insurance company steps in, handles the lawyers, manages the claims, and pays for the damages up to your policy limits. It's a stressful situation, but it's not a financially catastrophic one. You are protected. Your friend is protected. Your assets are safe. The difference in premium for that foundational, absolutely critical piece of coverage might have been $10 or $15 a month. Is there any universe where risking financial ruin is worth saving the price of a few cups of coffee? The policy contract is everything. And there's one more area where these differences can be life-altering. It has to do with what happens when the person who hits you is the one with bad or no insurance. This involves your uninsured and underinsured motorist coverage, or UM/UIM. Let's say you have 3 cars in your household, and on each car you have $100,000 of UM/UIM coverage. One day you're in a crosswalk on your bicycle, and a distracted driver runs a red light and hits you. The driver has no insurance. Your injuries are severe. Your medical bills and lost wages quickly exceed $300,000. With a quality policy, you would likely be able to do something called stacking. Because you paid for that coverage on 3 separate vehicles, the policy allows you to stack those limits together. Your $100,000 limit becomes $300,000. You can combine the coverage from all your cars to cover the damages from this one devastating accident. It's an incredibly important feature that creates a powerful safety net for you and your family. Now you call up your super cheap direct provider. You explain the situation. You tell them, "Great, I have $100,000 in UM coverage on each of my 3 cars, so I have $300,000 available." And you can probably guess what happens next. The adjuster politely informs you that your policy contains an anti-stacking provision. The contract you agreed to online explicitly states that no matter how many vehicles you insure with them, you can only ever collect the limit from one single vehicle. So your recovery is capped at $100,000. The other $200,000 in medical bills and lost income? That's your problem. You were paying premiums for 3 separate coverages, but the fine print only allows you to ever use one. You were sold an illusion of coverage. These are not small nitpicky details. This is the entire substance of the product. The quality of parts, who is allowed to drive your car, and how you can access your own coverage in a crisis. These are the pillars of a good auto insurance policy. The direct-to-consumer model, in its relentless pursuit of a lower price tag, often achieves it by eroding these pillars, replacing them with hollowed-out versions that look the same on a quote screen but crumble under the slightest pressure of a real-world claim. And the terrifying part is, you won't know your policy is hollow until it's too late. You only discover the fine print after the crash, when you're at your most vulnerable. So the policy contract itself is a massive, hidden variable. But even if you could find 2 policies, one direct and one from an agent, that were written with the exact same language, word for word, there is still one more colossal difference. A difference that has nothing to do with contracts or coverages, but everything to do with human nature and what happens when you actually need help. It's the difference between being a policy number in a queue and a person with an advocate. And that's the final piece of this puzzle. So let's break down what that puzzle piece, that advocate, really means in the real world. Imagine this scenario. It's 7 p.m. on a Tuesday. You're driving home, you're tired, maybe it's raining. And then bam, the sickening crunch of metal. Your airbag deploys, your car is mangled. You're shaken, but thankfully you're okay. Now what? Your heart is pounding. You have 1,000 things running through your mind. Is the other driver okay? Do I call the police? What do I say? What do I not say? In that moment of pure chaos and adrenaline, you have 2 very different paths. Path 1 is the direct writer path. You pull up an app on your phone, or you dial a 1-800 number. You wait on hold. You finally get a person in a call center, maybe thousands of miles away. They're reading from a script. They ask for your policy number. They tell you to take pictures. They tell you an adjuster will be in touch in 24 to 48 hours. You are now a case number, a file in a digital queue. Any questions you have, any help you need, is filtered through this impersonal system. When the adjuster finally calls, their job, their performance review, is based on closing your claim as quickly and as cheaply as possible for the company. They are not your advocate. They are the company's advocate. Path 2 is the independent agent path. In that same moment of chaos, you make one call. Not to a 1-800 number, but to a person. Your agent. Maybe you have their cell. You say, "John, I've just been in an accident." And John, your agent, immediately shifts from being a salesperson to being your crisis manager. He says, "Okay, first, are you all right? Is everyone safe? Good. Now, here is exactly what you need to do. Do not admit fault. Exchange information. Take these specific photos. I am filing the claim for you right now, and I'm going to be your point of contact through this entire process. If the other company's adjuster calls you, you tell them to talk to me. We'll handle this together." Do you feel the difference? It's not subtle. It's the difference between being alone and having a professional in your corner. One path adds stress to an already stressful situation. The other path removes it. This brings us to the ultimate question we set out to answer. Are direct auto insurance companies cheaper? And the real answer, the one that goes beyond the price tag, is about understanding the concept of total cost of risk. Your premium, that monthly or yearly payment, is only one tiny piece of your total cost. It's the piece you see. The cost you don't see, the one that can financially ruin you, is the cost of an uncovered claim. It's the cost of a poorly handled claim. It's the cost of your time spent on the phone for hours, fighting with an adjuster who is trained to pay you as little as possible. It's the cost of the stress that puts on you and your family. It's the cost of accepting a lowball offer on your totaled car because you're exhausted and you just need to move on. Buying insurance based on premium alone is like buying the cheapest parachute you can find. It feels like a smart, frugal decision right up until the moment you actually have to use it. And in that moment, you don't care that you saved $100. You only care if it works. Let me tell you a story about two families, the Smiths and the Joneses. They lived in the same town, drove similar minivans, and had nearly identical insurance needs. The Smiths went with a big-name direct writer because a TV commercial promised they could save $500 a year. The Joneses used a local independent agent their friend recommended. Their premium was about $40 a month higher. One icy winter morning, both families, in a stroke of unbelievable bad luck, were involved in separate but similar accidents. Both of their minivans were totaled. This is where their stories diverge completely. Mrs. Smith, with the direct writer, called the 1-800 number. She spent a week playing phone tag with an adjuster. The adjuster finally offered her $16,000 for her minivan. She knew it was low. KBB and local listings showed similar models going for closer to $21,000. She argued. The adjuster sent her a market valuation report, generated by a third-party company, filled with dissimilar vehicle comparisons from hundreds of miles away. He told her, "This is what the system says it's worth. Take it or leave it." Mrs. Smith spent the next 3 weeks fighting, hours on the phone, escalating to managers, sending in her own research. The stress was immense. In the end, they budged a little to $17,500. Exhausted and needing a new car for her family, she gave up and took the money, losing thousands of dollars in real value. Her $500 in yearly savings just evaporated into a $3,500 loss, not to mention the weeks of agony. Now let's look at the Joneses. Mr. Jones called his agent, Sarah. Sarah handled everything. When the insurance company's initial offer came in, it was also low, around $16,500. But Mr. Jones didn't have to fight. Sarah did. She told the adjuster, "That's not a fair offer, and you know it." She ran her own valuation reports using the professional tools agents have access to. She found 3 specific local examples of the same model minivan selling for over $21,000. She packaged it all up and sent it to the claims department. She made the calls. She escalated the issue. 2 days later, the insurance company called back and approved a settlement for $21,200. The Jones family got the full fair value for their vehicle. Their extra $40 a month in premium paid for an advocate who saved them nearly $5,000 in weeks of stress. So let's bring it all home. Are direct auto insurance companies cheaper? The answer is yes, sometimes the premium is lower. But it is a false economy. It's a discount you pay for with risk, with your time, and with your peace of mind. The real question isn't, Who has the cheapest price? The real question is, who provides the most value and the best protection when my world is turned upside down? The direct model is built on volume and automation. You are a number in an algorithm. Their goal is efficiency at a massive scale, which often comes at the expense of the individual client. The independent agent model is built on relationships and expertise. You are a client, a neighbor, a person. Their goal is to retain your business for life by providing expert advice and being your champion during your absolute worst moments. So what should you do? My call to action for you today is not to just go online and get a cheaper quote. It's to change the way you think about insurance entirely. Stop shopping for a price tag. Start shopping for a partner. I want you to do this. Open your browser and search for independent insurance agent near me. Look at the results. Read the reviews. Pick 2 or 3 that seem like a good fit. And then call them. When you call, don't just say, "I need a quote for my car." That's the old way of thinking. Instead, say this: "I'm looking for a professional to manage my personal risk. Can you tell me about your process for handling a claim? Can you tell me about a time you had to go to bat for a client like the Jones family?" Treat it like an interview. You are hiring a personal advisor. The quality of that conversation, the confidence in their voice, the stories they tell, that will tell you everything you need to know. It will show you the immense value that exists beyond a simple premium number on a screen. Because you're not just buying a policy, you're buying a promise. A promise that if the worst happens, someone has your back. A direct-to-consumer company can sell you a policy, but only a true agent, a true advocate, can deliver on that promise with human compassion and professional expertise. So, are direct auto insurance companies cheaper? On paper, maybe. But in reality, when the chips are down, the most expensive insurance you can possibly own is the one that doesn't pay, doesn't help, and leaves you to fight your battles alone. The cheapest insurance you can buy is the one that actually works. And that is the real answer.